Assalamu alaikum class. Today's lecture focuses on the calculation of interest expense on notes payable. We will also cover how to calculate the effective interest rate, particularly when the income tax rates are provided. To guide us through the practice questions, we will be using Financial and Managerial Accounting book by William Haka Bettner for practicing questions. In this lecture, we will be using Chapter 10, Liabilities, and we will cover brief exercises 10.1 and 10.2. So let's begin. I'm going to share with you the Excel sheet. Here it is. So in the exercise 10.1, the company borrowed $10,000 on a 1 year, means time period is 1 year, that borrowing is for 1 year, 8% rate of interest is given, and the date of the borrowing is 1st April. Interest was paid quarterly. Quarterly means interest was paid 4 times in a year, and note was repaid 1 year from the time the money was borrowed. Means the money was borrowed on April 1st on year one. 1 year means the money will be repaid, or the note payable will be repaid on 30th March of the second year. Calculate the amount of cash payments that was required to make each of the 2 calendar years that were effective by notes payable. So, first of all, we will have to calculate the cash payments year one and year two. Just calculations are required. So, cash payments required in year one. We are going to calculate, first of all, only interest is required to be paid for 3 quarters from April, May, June, July, August, September, October, November, December. So this 9 month basically covering 3 quarters. So we are going to calculate interest amount by 3 quarters. Total borrowing amount is $10,000. We will multiply it by 8% because rate of interest is 8%. So the 8% interest means 1 year interest is 10,000 multiplied by 8%, which is $800, which is $800. Now, this 1 year interest expense represents 4 quarters because payments are made quarterly. So we've divided by 4. So per quarter payment is dollar 200. So first year will be covered by 3 quarters from April to December 31st because the company is using calendar years. So from April 1st to December 31st, there are 9 months. 9 months mean 3 quarters. So company is going to pay interest for 3 quarters. So year one, 3 quarters payment are total $600. So first year total payment is $600. When we are going to calculate cash payments required in in year two, after 3 months, means after quarter one, January, February, and March. On 31st March or 30th March, the company will have to pay 3 month or 1 quarter interest, as well as the company will have to repay the note payable amount. So interest calculation is the similarly as year one. Then multiply by 10,000, multiply by 8%, which is $800. This $800 represent 4 quarter, means quarterly payment is 200. And in year two, we are covering just 1 quarter, which make interest payment is just $200. And the repayment of the next is repayment of loan as well, or notes payable, which is $10,000. So the total amount which is required to be paid by the company in year two is 10,200. This is the second year payment, 10,000. So the total interest is the 600 and 200. Total interest will be paid $800, and $10,000 is the total repayment of loan. So this was exercise 10.1, in which we simply calculated interest expense in year one and year two. In year one, we have 3 quarters. In year two, just 1 quarter is remaining because the loan was for 1 year. So we will have to complete just 4 quarters. The next exercise is 10.2, which is in 10.2. One of the advantage of borrowing is that interest is deductible for income tax purpose. So, if a company pays 8% interest on 8% interest to borrow $500,000, but it is an income tax bracket that requires to pay 40% income tax. What is the actual net of interest cost that the company incurs? So actual, as we know that as we know this in interest expense is a deductible expense for income tax purpose. So we will have to calculate interest cost before income tax and interest cost after income tax, which is called net of tax. So requirement number one, or A, first of all, calculate interest cost which is before income tax. So company has borrowed $500,000, on which company will have to pay annually 8% interest. So multiply it by 8%. So the annual interest would be $40,000. And this annual interest is before tax, any adjustment before tax. So tax savings via deduction of interest. So tax savings are basically 40%. Income tax rate is 40%. So 40% will be saved. Like you can calculate it, the total um, income tax, total expense, interest expense is 40,000. So multiply it by how much company is going to pay interest. Company is going to pay income tax, which is 40%. So total tax savings are 16,000. We will deduct this 16,000. So this is the interest cost after the deduction of income tax, which is called net of income tax. This was requirement one. In requirement number two, what is the effective interest rate that is paid by the company? So, next requirement is to calculate effective interest rate, and the rate of interest is 8%. So, we will minus a 1 minus T. T stand for income tax rate. So for calculating effective interest rate, T is or tax is zero point 0.4, or you can say 40%. So effective interest rate will be 0.48, or in terms of percentage, it is 4.8%. So the effective interest rate is 4.8%. So that's it from this lecture. Take care, class.